Okay. Okay, could everyone see?
Yes.
Well, thank you, Neil and everyone for having us this morning. We're looking forward to talking to you a little bit about what we do and how we're thinking about the current economy, the markets, and some other issues that may be coming up. My name is Donnie Shulman. I'm here with Greg Aswani. In our roles, we work with high net worth families, institutions, nonprofit endowments, all across the wealth spectrum. And there are very few situations that we haven't seen. Um, our client sizes run the gamut between 5 million in assets all the way up through hundreds of millions. So we have a lot of unique situations that we're dealing with. And what we do is we try to compact all the information together um, that we generally speak about into this presentation to give you an idea of how we're thinking about managing our clients' assets while everything is a bit crazy. So before I start, I'm just going to give you a little bit of background on the firm. So we're the oldest bank in the country. Alexander Hamilton actually founded us. So if you've watched Hamilton on Broadway or recently on Disney Plus, he was talking about us. We were actually the first corporate trustees in the U.S., and that was actually created for Hamilton when he was shot because apparently he died penniless, and his friends put the hats together and created a trust for him, and they asked the bank to be the trustee to make sure his family was taken care of. We are considered one of the safest and most stable banks in the country, and recently we were even asked by the U.S. government to be the custodian on the infrastructure services for the Coronavirus Relief and Economic Securities Act, to basically the legal fiduciary to make sure that assets, when they're distributed, are distributed correctly from the treasuries. We have about $1.8 trillion in assets under management for institutional $36 billion of assets on the private wealth side, and about a fifth of the world's daily financial transactions. So $35 trillion every day runs through the bank through Pershing, one of the bank's subsidiaries. So the short version is we've had a lot of experience in building up our disciplines. And before we really talk about the investment piece, it's important to talk about our philosophy just for a moment, because what typically happens is when someone thinks wealth management, they automatically think investments. Especially when markets are volatile, investments is really one piece of the wealth management pie. These are our 5 active wealth disciplines. Whenever we look at our clients, we try to be holistic, just like most of the rest of you. When you look at your clients, it's not just about one thing, it's how I work with your client as a whole. So investing obviously is a key lever that we always think about, but how clients borrow, how they spend their money, manage taxes, and protect their assets are all different pieces of making sure that client wealth continues to grow, or at least not to lose assets when it could be avoided, especially when markets become very volatile. Also, some of the ways we work with our internal and external partners.
Did you start? Is it me? You?
Again?
Okay.
Oh.
It just froze for a second. I don't know if that's my cue.
Is it going again?
Yes, you're good.
Thank you. And what we actually did at this point is they quantified the value of good advice, and I'll share that information with you. A lot of people much smarter than I actually ran the numbers, and I could give you, if you really need, I'll go back and get how they calculated some of these. But for example, if we take investing, the average investor, each fund investor returns about 3.9% annualized over time, and I believe a 60-40 portfolio. By just sticking to a stringent investment policy, rebalancing, you could add up to 1.7, so 5.6 return versus the 3.9. That's how they got to some of this advice alpha, and that goes across the board. And they found over the course of 20 years or so, if they look at these clients, they said, okay, how much does good advice actually worth? It goes for most of you also. When you're advising your clients, you're actually increasing their wealth just by giving them good advice. So I think that is one of the key takeaways that we'll talk about today is when we have information, how do you advise your clients on utilizing that information? So with that, I'd like to introduce Greg to actually give you some of the economic and investment updates. Greg is one of the wealth managers. He works with our clients directly on their portfolios. He's been with BNY, I think 10 years, and has a wealth of knowledge and experience. And I'm going to hand it off to Greg to start talking about the economic update.
Okay, great. Thanks, Donnie. Can everyone hear me?
Yes.
Yes.
Okay, great. So, Donnie and I thought it would be, important and interesting to really kind of talk about one, where we are in the economy, what our thinking is, what our best thinking is on what's gone on, and also, going forward, what we see going forward, not only from an economic standpoint, from from market standpoint, as well as how we're positioning clients' portfolios to take advantage of opportunities that we're seeing here. Given much of the volatility that we've already experienced and will most likely continue to experience going forward. But maybe right now I'll take a step back and really just talk about the economy. Really, it's been, as everyone I'm sure knows, has been a story of kind of good and bad. A lot of bad, some good, but mostly bad, unfortunately, with the virus and the effect that it's had not only on the economy and the market, but families as well. There are, to a certain extent, a lot of damage has been done that may not be able to be reversed, but overall, economically, I think it is a story of good and bad. The good, it seems as though we have essentially, gotten past the worst. It looks like the world economy likely troughed in late April to early May, and we are beginning to see now green shoots in the economy, both here and abroad as well, that we view as a positive sign. If you look at things like unemployment, while the unemployment rate is still extremely high historically, we are approaching that 10% range in unemployment, which is a positive sign for our economy at least. Within manufacturing, we're seeing things like ISM manufacturing figures, peak back or move back into expansionary zone. In the Chinese PMI has begun to sort of touch that expansionary zone as well. So overall, I think we seem to have gone through sort of the worst already, and I think at this point we are pricing in or we expect now that V-shaped recovery. I think you can get lost in the alphabet soup of is it a V or is it a U or is it an L? That's sometimes I think clients get lost in the weeds there, but for the most part, we expect at this point where we are right now. There's about a 50% chance that we would experience, or we are experiencing, a V-shaped recovery. A lot of things have to happen to have that true V. Number one really is being the control of the virus and the control of the spread. We've already seen flare-ups in the West and the Sun Belt. We're also seeing some flare-ups overseas as well. So much remains to be seen, but overall, we think the most likely case economically is that V-shaped recovery and returning to those pre-COVID levels sometime late 2021, early 2022. The other possibility, and is certainly a possible outcome, is that U-shaped recovery, where we see a spike in the fall of the virus. A spike in the virus in the fall, autumn timeframe. We're not able to either produce a vaccine at a quick enough rate, or if we do see a spike, you'll eventually see certain economies stop or slow down, and we'll have to institute additional social distancing policies. So that's obviously a chance, and that's certainly a possible outcome. We think the most likely outcome is still that V-shaped recovery, given everything that we've seen so far. But again, I always try to temper expectations with clients that we're certainly not out of the woods yet with this from an economic standpoint, and that there are a lot has to be done before we can really sort of rip the Band-Aid off and say we're past this. So as of right now, we're still seeing positive signs in the economy. We continue to see economic figures and growth figures come in stronger than anticipated, and I think that going forward we will continue to see that. So that's on the economy. That's really what we're thinking. Donnie, if you could just turn to the next page, if you don't mind. So how has that affected markets, and how have markets really reacted to this? Overall, I think it's been sort of Wall Street has essentially disconnected from Main Street. Much of that has to do with the actions of the Fed. I mean, and our government. We've seen record level stimulus injected into our economy, both by the Fed and the U.S. government. The Fed continues to be committed to, number one, keeping interest rates low, but also being a source of support for bondholders and the bond market. What they've done with not only the corporate bonds and being a secondary buyer of corporate bonds, but also injecting liquidity into money markets and the tax exempt market, even going as far as talking about possibly being a purchaser of ETFs, and down the road maybe even buying stocks. The Fed is committed to really providing liquidity. And I think that's helped the market. If you look at where we are year to date, this slide is as of June 30th, but even coming into July, it's been a theme of U.S. large cap stocks have been the best performer through all of this. U.S. domestic stocks have really benefited, I think, from some of the policies that have taken place. But overall, we've seen an aggressive rebound off of those March lows, and we continue to see the stock market grind higher. And that leads us to being somewhat cautiously optimistic about the markets. I think a lot of it's connected with what's going on in the economy, but we think overall, and I'll get into this in later slides, but overall we think that you will continue to see the market sort of grind higher as we move along here, being led mostly by U.S. large cap. We think that overall U.S. large cap stocks have sort of we're the best positioned to sort of survive through this new COVID time frame, and we think that U.S. domestic stocks will probably continue to benefit from those policies. If you look at fixed income, fixed income really is in March was probably one of the most volatile times that we've seen in fixed income and fixed income pricing in quite some time. I'll get into this in a few slides as well, but in March you saw spreads widen out and prices on bonds really disconnected from the true fundamentals. I think there was that real risk-off trade and that fear trade that created a lot of volatility. And I can't tell you how many clients of mine who are strictly bondholders or historically conservative investors that for the first time in a long time saw negative values on their portfolio and really had a shock to the system. We stood pat and said, listen, a lot of this has to do with a risk off, and there's a fear trade. The second the Fed came in and really injected that liquidity, you saw bond prices begin to normalize. And as you can see for the year, bond prices are essentially flat to positive. So that's been a good sign, I think, for fixed income investors as well, is that we've sort of made it through the COVID fear, so to speak, the fear of mass and wide scale defaults. And I think at this point, we'll continue to see bond prices sort of probably flatten out for the most part. I mean, we keep calling for higher interest rates, and 2 years ago we were calling for higher rates. Last year we were calling for higher rates. We never really got there. We think a lot of obviously what's gone on with the economy will continue to keep rates low. So for the most part, we think bonds will probably be a stable asset class. You're not going to get much return, but you will have that principal preservation aspect to your portfolios. And then on the flip side, on the alternative side, alternatives are a very mixed bag of different asset classes, right? Long, short, absolute return. I think what we saw is, for the year, obviously they've moved lower, in sympathy with how equity markets have done. But what we did see was back in February, March, April, a lot of those long, short, absolute return funds actually did what they were supposed to do, and they held up and managed a lot of that volatility relative to how traditional stocks and bonds have done. So I'll speak to our thinking on alternatives in a bit, but overall it was nice to see the alternatives perform relatively well during the volatility that we experienced a few months ago. Donnie, next slide, please. So, is the worst behind us? We think that the worst is behind us at this point, at least in the U.S. If you look at sort of our traditional economic factors, things like the ISM Manufacturing Index, that has officially moved over that 50 mark, which historically stands for an expansionary time period. Retail food and sales figures have spiked since sort of those March lows. Initial jobless claims, which you know, we've seen some volatility around recent reporting and initial jobless claims, but we have seen obviously much of America getting back to work, either getting their jobs back or just re-entering into the workforce, which has been a positive sign, I think, for our economy, and that we think will continue to get stronger, again, assuming that we can have some sort of control around this virus and control around not needing to shut down, state and local economies. And then lastly, you know, the consumer confidence. I think consumer confidence has been is obviously a very volatile metric, but we have seen those confidence figures both on the consumer side and the business side recover since the peak of the volatility in March. Donnie, next slide, please. And on a global scale, you know, obviously there are, you know, the global economy is a mixed bag of various economic factors, but we are seeing a recovery in quite a few areas. You know, obviously mainly being China. The Chinese PMI manufacturing index officially moved back into expansionary territory. Again, some of those figures you can sort of take with a grain of salt, obviously, because, you know, we don't really, I think truthfully know the exact extent of the expansion in China, given some of their data can sometimes be questioned. But overall, we are seeing a pretty strong recovery in China and beginning to see a recovery in Europe. Obviously, you know, economies like the UK, Spain, Italy, you know, they had contractions in GDP of anywhere between 20 and 30% during the peak of COVID. We are beginning to see those economies turn back on, not as fast as the U.S., but overall we are beginning to see those economies turn back on and begin to sort of normalize a bit. So we have seen a pickup in overall Eurozone market PMI manufacturing as well. Next slide, Don. So this slide really goes into credit spreads. And I kind of hinted at this before, but, you know, for fixed income investors in March was probably one of the most difficult times for those folks in quite some time, because what we saw was, again, this massive risk-off trade and bond prices really disconnected from the fundamental values of what they were actually worth, given the fact that everyone thought the world was going to end, there were going to be mass defaults. So what we saw, what this slide shows is our credit spreads, and credit spread is essentially the difference in marketable yield of a bond over treasuries, which are viewed as, you know, a safe haven investment. And as you can see, during the peak of that risk-off trade, you know, credit spreads really blew out and widened out. The Fed stepped in, provided liquidity, not only to tax-exempt and the taxable bond market, but also, you know, money markets and short-term liquidity as well. And what we began to saw is, again, those spreads tighten. And this has a lot of this has to do with overall, you know, the overall pickup in the economy. We think as investors continue to be more confident in what has gone on from an economic standpoint, those credit spreads should continue to tighten. But a lot of it has to do with the Fed, and the Fed maintaining the policy of, you know, we are going to keep markets as liquid as possible. We're going to keep rates as low as possible. You know, they come out and speak today, I believe, today or tomorrow. And I think the expectation is that they'll probably continue on this policy of support. And they'll use whatever tools that they can to keep that support in markets. And that's why, you know, to a certain extent, the saying is don't fight the Fed. I mean, we really are in a don't fight the Fed environment. I don't think you want to make any bets against what they're going to do. I think they're going to keep rates low and do whatever they can to inject liquidity into markets. And we've seen that help not only on the equity side, but also in bond pricing as well. So I think we will continue to see spreads tighten overall as we go forward here. So again, assuming that there is no massive wide-scale pickup in the virus spread. Next slide, Donnie. So what we did also was, you know, we took a look at past performance of the S&P. You know, a lot of times I get the question from clients, you know, we've seen obviously an extremely quick recovery here. You know, what do you guys see going forward, or what would you expect going forward? That's obviously a very loaded question, but if you look at historically, performance on the S&P after a large quarterly, positive performance period. So anywhere from 15% to 25% positive. You know, what we usually see is that continued momentum, or, you know, that continued steam behind the market into later quarters as well. So, you know, we don't exactly know how the market will perform, which is why we're obviously cautiously optimistic on the outcome of equities and the outcome of the equity markets. But overall, if history is a barometer, what history shows is that you can continue to experience positive returns going forward in equity markets, even after a surge that we've experienced, such as the one that we've seen in this April, May, June time frame. So, this slide really is, I could spend probably 45 minutes on this. This is probably the most interesting slide or the slide that I think garners the most interest from our clients right now, and I think it's on everyone's mind, is the election. So it's a bit of a busy slide, so let me kind of walk you through sort of the numbers here. On the bottom, I'll start with the bottom first. Really, this is the betting odds of a Trump versus a Biden presidency. I think everyone pretty much knows right now where we are, that Biden has a pretty strong lead in the polls. Things can be said about polls, and if you believe in polls or if you don't believe in polls, obviously that's a whole different conversation. But right now, where we stand, the betting odds are that Biden will take over the White House, going into next year. Again, a lot has to happen between now and then. I think we're not into debate season yet. Historically, even if you look at 2016, the polls had Hillary Clinton ahead. I think even the day of. So again, a lot can happen between now and then. But right now, if you go strictly by the polls, Biden is currently in the lead, and I think the market is somewhat pricing that in at this point. A Biden presidency. So at the top, what we also looked at was, from 1936 to 2016, how has the S&P performed during an election year in and around when either the incumbent party has won or the incumbent party has lost? And I think it's pretty much what you would expect. In a scenario where the incumbent party loses, you usually see some volatility around the market. You usually see a drop in the S&P, but overall, I think the market sort of at some point finds its footing and continues its next leg higher. Obviously, if the incumbent party wins, usually you see sort of the market kind of continue on its path the way that it was going. Again, this is, I get the question a lot from clients is, what can we do around this? How can we defend, or how can we prevent this, or not prevent this, but I guess invest for this? It's a very difficult question, right? Because you don't know. We have a hint of what Biden's policies could be. We have I think we kind of understand what Trump's policies will be and have been. And I think that's why we try to stress investing for the longer term. Not looking at a 12-day time frame or a 6-month time frame. We try to keep clients invested for 2, 3, 4, 5 years. And for the most part, if you look at the market, you look at how the market reacts to who's in DC or what's going on in DC. The market does not like uncertainty. I think the market can sort of digest, react to what's gone on or what new policies may be in DC. But overall, what the market doesn't like is uncertainty, and that's what creates volatility. So, sort of to wrap that statement up is, we do think that there will be some volatility around the election. This is probably one of the most charged elections that we have seen in quite some time. If Biden does get in, you will likely see, some policies that may hurt corporate balance sheets, that may hurt the personal investor to a certain extent from a tax standpoint. He's talking about looking at capital gains tax, and obviously, I'm sure everyone on this call knows better than me, what those policies may be. But I think we may be looking at a very different sort of environment, at least investing environment during a Biden presidency. But overall, I think that's why we also try to focus clients on longer term, and that's why I think as an active manager, it's our job to read, react, and respond to what those policies may be, and how we can invest our client assets. So if you go to the next page, Johnny. So this is really a snapshot of sort of our best thinking right now and how our client portfolios are positioned. Really overall, we are essentially, most confident in equities, and within the equity landscape, we think U.S. large cap is the best place to be. And I think that's benefited our clients as well, given, I'll go into sort of what we did from an active framework on the next slide, but we thought back in March that, U.S. large caps were sort of the best place to be, best house on a bad street, so to speak. And we've allocated more of our client dollars and more of our client assets towards U.S. large cap portfolio, or to our U.S. large cap portfolios. That being said, we do believe in diversification. We do believe that you should have exposure to a multitude of asset class asset classes. We feel longer term that does lead to a better risk-adjusted portfolio and a risk-adjusted, returns as well. So overall, I think, we favor U.S. domestic equities within that landscape. We favor U.S. large cap, but we do feel that it's important to have an allocation to things like Eurozone equities, international developed equities, emerging markets as well. Within fixed,
just in general, and I know
within
I
fixed,
be doing this, but I love these speaker presentations. I love it.
Sorry, I'm getting some feedback. If someone has a question, please feel free to interject. But if not, I'll keep going. Okay. So within fixed income, we are less favorable or less positive on future outcomes within fixed income. Not that it's not an asset class that you don't want to have, your clients' assets invested in. Right now, we think fixed income, just given where rates are at, historic lows. We're not sure rates can go much lower. We don't think negative interest rates is a possibility in this country, but again, you never know. So we think going forward, fixed income will act as a ballast in the portfolio, act as sort of a principal preservation piece of a portfolio and income generation, but we're not expecting much return out of fixed income. So that's why we're using it more for principal preservation for those clients who want that asset or that sleeve to their investments. And then lastly, on the diversifiers, we think given the volatility that we've experienced and will likely continue to experience, we think diversifiers play an extremely important role in risk-adjusted returns for client portfolios going forward. You do want to have an allocation to some asset classes that will, for lack of a better term, zig when everything else is zagging. We saw that in March and April when volatility spiked. Our long-short allocation, our absolute return allocations really helped defend client portfolios against a lot of that volatility. And we think that volatility is a theme going forward. So that's why we will continue to recommend that clients have an allocation to diversifiers or alternative investments within their overall portfolio allocation. And then last but not least, this slide really looks at, okay, well, how have we made changes at the portfolio level to react or respond to what's gone on in markets? And this slide goes back a few periods and a few quarters as to how we reacted or how we adjusted client portfolios. One thing I always tell clients is, this is why you have an active manager. It's our job to sort of read the tea leaves and also separate the emotion of investing and look at fundamentals. And one example of that was back in March. We viewed this pullback as a buying opportunity, specifically within U.S. large cap. And I can't tell you how many conversations I had with clients where they thought I was crazy, really did not want to make that move. And I think that's why you hire an active manager. We saw the opportunity within the equity space. Valuations had really pulled back to a point where it looked like we were in an oversold environment. And so what we did was we adjusted client portfolios, allocated more client dollars towards U.S. large cap. And if you look at the returns that we've already seen so far, even the past 2 to 3 months, that really benefited client portfolios. And I think we'll continue to provide dividends going forward for our client assets. So that's sort of one example in a wide array, I think, of our active management and how we try to position portfolios. But I think this is sort of an example of we are backed by institutional style wealth management where we have a lot of not only analysts but professionals that are looking at the market and saying, okay, yes, I understand this is a scary time, this is a very volatile time, but how can we make changes at the margin within client portfolios that will benefit them longer term, rather than just creating a set it and forget it allocation where we think that you should have 20% to large cap and that's it, we shouldn't go any further. There are times where you do want a large allocation to certain asset classes where there's value. So I think that really speaks to how we position client portfolios again, and how we sort of it's our job again to read the tea leaves and understand what's going on, and then make adjustments at the portfolio level. So overall, I think that's where we're still positioned that way. If you had to take one thing away from from my 20 or some odd minutes of rambling here, it's I think we are cautiously optimistic on equity markets. We think that we will continue to grind higher, assuming that there is no massive spike in in the virus, and we think economically we will continue to recover going forward. So with that, I think we're going to save some time for Q&A at the end, but I'm also going to turn it over to Donnie for some closing comments.
Thank you very much, Greg. I appreciate the insight. This next slide is a very interesting one because this is what you see in the news. You see the cases in the US are going up, the cases in Europe are going down, what's going on, everything becomes politicized, everyone's getting emotional, and this is what everyone sees and talks about. And the issue that we run into with a lot of our clients is, yes, we're managing for short term, what's happening in the market, we're also managing for long term, but part of what we do is we step back from this and we look at the bigger picture. And I think as advisors to our clients, and this applies to everyone in the room, is when you're stepping back from the bigger picture, you get to the good. Vaccine treatment is coming along. Phase 3 trials have begun. Newer, faster tests for COVID are coming out. Whether or not it's a 3 trillion plan or 1 trillion plan, the U.S. government is going to be continuing to inject money into the economy to help everything just push and grind forward until we have treatment for COVID. And most of the time, again, we focus on what everyone's reacting to. Just this is the news. It gets politicized, it becomes a hot topic, and you don't consider all the background and all the good that's happening. And when we take the whole picture, we can say, okay, our strategy is looking at this from the bird's eye view, and what is going to happen next, not just what's happening now. So just to bring you to some key takeaways, the way we think about things, at least right now and then moving forward, really flattening the curve around hotspots is going to be key. The better we are as a country, the better we could open up. As Greg mentioned, we do think we're going to get to pre-crisis levels and probably continue in an expansionary market at that point. And the Fed, U.S. Congress Fed, they are injecting tons of stimulus, and the Fed hasn't used all the ammo in their gun yet. They've taken major steps and unprecedented steps with their bond buying programs. They started with buying muni bonds, then corporate bonds, they're up to corporate junk bonds, and they've announced unlimited QE, which is basically they will buy anything to keep liquidity in this market. And if need be, they may even go to buying stocks to keep liquidity in the stock and equity market as well. So we haven't gotten there yet, and there's a chance they might not, but we know that they're willing to do what they need to keep everything floating until the economy is able to reset. The last thing, bringing us back to what I said in the beginning, is active wealth, actively thinking about how overall wealth is being managed. So not just the investment portfolio. Someone might see a buying opportunity in real estate, and they have to figure out how to do that. If you're not borrowing correctly, if you say, okay, I don't like the stock market, I'm going to sell everything and buy real estate, that might not be the best thing because you might be buying at a bottom and not capturing that upside. So being able to talk to the advisors, I know we have some real estate folks on this call, talking to Tim, I think that's you, and saying, what's the best way to get this piece of property? That's really how to think and get good advice versus just reacting. So I think that's all we have for now, and we're happy to take questions from the group on anything we've said, and if you have any conversations or questions on topics that we didn't mention, we're happy to talk about that as well.
Anyone have any questions? They can chat the questions or raise their hand. I think
I
we
got
have
a question. Greg, what do you think about the election as it relates to the House and the Senate? What are you telling your clients regarding that as well?
Sure, that's a great question. I think right now the thinking is that there may be that new blue wave, so to speak, where the Senate turns blue, obviously the House stays blue, and then we get a Biden presidency. That's certainly a possibility. Right now, what we're thinking is that in most likely cases, that you will see the Senate continue to be GOP dominated. The House will most likely obviously stay blue, and then if Biden is president, you'll kind of get that traditional, Democratic president, GOP Senate, Democratic House, and that actually might be a good thing for the market. Well, it might not be a great thing for policies. If there's a logjam in DC and they can kind of get out of the way of the stock market, I think you'll most likely see that be a positive outcome, at least from a stock standpoint. I think if you do see that blue wave and you do see obviously a blue Senate, you'll most likely see a reaction in the stock market. How heavy that is, we don't really know. Again, there usually is a recovery at some point, but I think that will scare investors for the most part, just given the fact that there may be new tax policies coming down the road, right? Taxes on dividends, taxes on capital gains will most likely change, and I think we have some clients who are trying to get ahead of that. From a planning perspective, it's really hard to sort of make a black and white answer on that, because if you say, okay, we're going to sell all of my low cost basis stock right now for the fear that capital gains taxes may be higher in the future, and if Trump wins, then all of a sudden you're in a scenario where you did all of that for nothing, essentially. So right now we're kind of in this in between period, but we are I guess that is a concern for a lot of clients, and right now we just unfortunately don't have an answer for that.
Okay, thank you.
One thing we do know, that we're in unprecedented times as far as deficits. Both state, local, and federal have big deficits. And we said this in meetings past. If we are to predict anything from an economic standpoint, there will be taxing next year. We think the estate tax is the most vulnerable to be attacked. And we have a lot of people, especially getting rid of the stretch IRA and other things. We were talking about this earlier, that life insurance seems to be one of the safest places to protect your money and to keep it tax-free to your heirs. So I know we talked briefly about 1031 exchanges and whatnot, and we're going to have a future meeting on charitable trusts. But at the end of the day, we have to be tax efficient and be wary of future taxes coming. We just can't keep spending without there being some sort of we have to, the deficit can't keep growing to unlimited amounts. That's all.
Neil, I suspect we're all going to be very busy in the second week of November through December 31st if there's a change in presidents.
Yeah.
Very busy.
I don't know about, so Larry and Neil, with the rest of the people on the call, but I know that I've already been planting seeds in some of my clients' heads to start thinking about this. Especially in New York State tends to follow federal in terms of estate taxes. So when federal raises, New York State will raise. If federal decreases, then the New York State tax cliff might decrease also. So everyone the example of a client that's been planning for that $5 million tax cliff for a couple of years now, and we said, okay, we got to start thinking, what happens if it gets reduced? Are you prepared for that? So just planting some seeds might be helpful even before the election happens, so that when the election happens, you can call them back up and they'll be like, oh, okay, we're ready to start doing something, and from scratch conversation.
Well, going back to the Great Depression, and I have to say that because that's when we had unprecedented unemployment numbers. In the 30s, the estate tax rate went up to 70%. 70%. So I'm not saying that that's going to happen, but if we do look back at history and look at employment numbers and look at deficits and how do we come back, that seems to be the most vulnerable tax out there.
I think that, and potentially capital gains. I think there's been
capital gains as well. So
around, especially for high net worth individuals, the long-term capital gains tax is fairly low. and to be taxed at regular income versus special treatment is a distinct possibility, especially in this environment. So that goes to clients also that have real estate, or especially long-term holdings in real estate. You might see a wash of people looking to unload right before the new year, and that might affect the real estate market if the capital gains tax is going to be affected. So there's a lot of things that are up in the air, but I think what you were saying, Neil, the estate tax is something that's easily on the chopping block, and then capital gains tax. And I think part of the reason is it doesn't affect the middle class as much as other taxes do, so just regular income tax. And if you're seeing a push from the Democratic side, they're going to try and see what they can do to the
Billionaires tax.
class. Yeah.
Billionaires tax.
And I think one of the most valuable parts of this meeting is, as a resource to everyone in this group, Mellon is a terrific partner. They sponsored this event. We've been in discussions for numerous things, and I have to tell you, it's good to have a bank of that size, of the various things they do for private wealth management, working with us in various areas. So thank you both for the presentation, and I think it's very important. And again, if anyone wants to follow up with anybody in our group, we're happy to make connections, and we have tons of resources here between Larry as far as an attorney, and Larry Bloom, who's brilliant CPA, and Phil, who does forensic accounting, and Tim, who does great job with mortgages, and Mellon, that does great job in managing finances, and of course me, who's an insurance expert. Don't forget about that, but that's all good. So listen, we thank everybody, and if anybody has any questions or wants to make a connection with anybody, just let us know. We're happy to help and be here for you.
Yep,
Thanks
I have
again.
one question before everyone goes. Do you know about our website? Neil, you want to tell them we're up and running?
Right. LAFPN.org, we're up and running. We will be posting a blog soon. We do have, we're going to have a YouTube channel, if we didn't start it already, with some of these meetings. And we're going to continue to promote these meetings. If there's any topics that anybody would like to cover in a future meeting, let us know. Again, I can't say enough, but thank you.
Thanks, guys. Appreciate it.
Have a great day, guys.
Thanks for the
Have a great
info. It was
day.
really helpful.
Thank you for having us.
Nice program, guys. Thanks. Take care.
Thank you.